Okay, so you want to own a self-storage facility. In fact, there are tens of thousands of self-storage facilities across the United States, more than many of America's most recognizable retail chains combined. That sounds unbelievable until you understand the economics behind them. No leases to negotiate, no toilets to unclog, no midnight calls about a broken furnace, just rows of orange doors that people pay you every month to keep locked. It has a reputation as the laziest form of real estate in America, the one investment where you supposedly get paid to do almost nothing. And there is some truth buried in that reputation. Self-storage genuinely carries lower operating costs than nearly any other property type in commercial real estate. But the story of how this business quietly became one of the most profitable niches in the industry, and why it has also become far more expensive and far more competitive to enter than most people assume, is a story worth understanding before anyone signs a purchase agreement. Let's start with what you are actually buying. A mid-sized self-storage facility, something in the range of 500 to 600 units in a secondary American market, typically sells for somewhere between $3 and $6 million. That number climbs quickly in dense metro areas where land is scarce, sometimes past $10 million for a facility sitting near a busy highway exit with strong visibility from the road. Lenders in this asset class usually require 25 to 35% down, which is notably higher than what is required for an apartment building because storage income is considered more discretionary than housing. On a $4 million facility, that means $1 million to $1.4 million in cash before a single customer ever rents a unit. Here is the part that surprises most new buyers. Storage looks cheap to operate compared to housing, and in many ways it is. There are no kitchens, no bathrooms inside individual units, no HVAC systems to replace inside 400 separate apartments. But land and construction costs for new storage facilities have climbed so much over the past decade that buying an existing, already stabilized facility now often costs more per square foot than it did to build that exact same building 5 years earlier. Developers who overbuilt storage in fast-growing suburbs between 2016 and 2021 created intense local competition in some markets, which means the facility you are buying might sit 15 minutes from three newer competitors offering the first 2 months free just to fill their shelves. Revenue in this business comes almost entirely from one source: monthly rent paid per unit. But the pricing structure behind that rent is more dynamic than most people expect. A standard 10 by 10 unit rents for somewhere between $100 and $180 a month depending on the region, and climate-controlled units command a premium of 20 to 40% above standard units because customers storing furniture, documents, or electronics do not want their belongings baking through a summer or freezing through a winter. Operators also lean heavily on something the industry quietly calls yield management, which is a polite term for raising existing tenant rents every 6 to 12 months, sometimes by 8 to 10% at a time. This works because the psychological and logistical cost of moving your possessions out of storage is high enough that most tenants simply pay the increase rather than rent a truck, find a new facility, and start the entire process over. This single behavioral fact that people hate moving their belongings almost more than they hate overpaying to store them is the quiet engine behind the profitability of this entire industry. Companies like Public Storage and Extra Space Storage have built multi-billion-dollar businesses around a concept that sounds almost absurd: renting empty boxes. These companies operate thousands of facilities across the country, and their scale is exactly what allows them to survive the very competition that threatens smaller independent owners, since they can absorb a soft submarket in one state with strong performance somewhere else, something a single facility owner simply cannot do. Now let's look at the expense side. Property taxes and insurance scale in line with any commercial asset of similar value. But the real operating advantage in this business shows up in staffing and overhead. Most facilities run on a skeleton crew, sometimes a single manager who lives on site in exchange for a discounted unit or a modest salary, supported by gate access software, security cameras, and an online rental platform that handles most transactions without a human ever picking up a phone. Add marketing spend to stay visible against nearby competitors, and total operating expenses for a well-run facility typically land around 35 to 40% of gross revenue. Compare that to the 45 to 55% that is common in apartment operations, and you start to see why storage earned its reputation as an efficient asset class. On a facility collecting $600,000 a year in gross rent, that leaves a net operating income of roughly $360 to $390,000 before the mortgage is even paid. But debt service still eats into that number the same way it does in every other corner of real estate. A $4 million facility financed with a $2.8 million loan at 7% over 25 years carries an annual mortgage payment close to $240,000. Subtract that from net operating income, and an owner is left with somewhere around $120,000 to $150,000 in annual cash flow on an initial cash investment north of $1 million. That works out to a cash-on-cash return in the 10 to 14% range in a good year, which genuinely outperforms most real estate asset classes, but it depends entirely on occupancy staying above 85%, a number that can slip fast if a new competitor undercuts pricing 2 miles down the road. The biggest risk in this business is not a bad tenant, because there is no eviction process for an empty storage unit the way there is for a delinquent renter in an apartment. If someone stops paying, the facility follows a state-mandated notice period, then auctions off the contents of the unit and re-rents the space to someone new. The real risk sitting underneath this entire industry is oversupply. Storage facilities are relatively cheap and fast to build compared to apartments or offices, sometimes going from empty land to a fully leasable building in under a year. That means a hot market can flood with new competitors within 18 months of the first successful facility opening. And once that happens, rental rates across the whole submarket can soften for years, sometimes even before the newer buildings are fully leased themselves. What makes storage genuinely different from housing, retail, or almost anything else in commercial real estate shows up most clearly at the exit. Because there is no tenant improvement cost, no leasing commission paid to an agent, and almost no maintenance capital expenditure sitting on the horizon, a stabilized storage facility can trade at a lower capitalization rate than nearly any other commercial asset, sometimes below 5% in strong markets. Buyers at that price are not paying for growth potential the way they might with an apartment building in an up-and-coming neighborhood. They are paying for the sheer predictability of the income, month after month, with almost nothing that can go structurally wrong. Owning a self-storage facility, in the end, is not a bet on a booming economy or a growing city. It is a bet on a much simpler and much older human truth, that people accumulate more possessions than their homes can comfortably hold, and that most of them would rather pay a stranger $150 a month than spend a Saturday deciding what to throw away.